Why do some stocks consistently outperform others? For decades, Wall Street assumed it was all about one thing: market risk. But in 1992, two professors, Eugene Fama and Kenneth French, discovered that market risk alone only explains about 2/3 of stock returns. They found two additional factors hiding in the data that explain most of the remaining variation. This changed finance forever. Before Fama and French, the dominant model was CAPM, the capital asset pricing model. It says a stock's expected return depends on just one thing: how sensitive it is to the overall market. Beta measures this sensitivity. A beta of 1 means the stock moves with the market. Higher beta, more risk, and theoretically more return. But researchers kept finding anomalies. Small cap stocks earned higher returns than CAPM predicted. So did value stocks with low price-to-book ratios. Something was missing. Here's the Fama-French three-factor model. A stock's expected return equals the risk-free rate plus 3 risk premiums. Factor 1. The market premium. This is what CAPM already captured: the extra return you earn for investing in stocks instead of treasury bills. We call it RM minus RF. Why do small stocks earn more? They're riskier, less liquid, more volatile, more likely to go bankrupt. Investors demand extra compensation for bearing that risk. Value stocks are the unfashionable bargains. They look cheap relative to their book value. Growth stocks are the darlings. Expensive but exciting. Yet historically, boring beats exciting. With historical premiums, the expected excess return is 1. 2 times 8% plus 0. 8 times 2% plus 0. 6 times 3, 5%. That's 13. 7% above the risk-free rate. Compare this to CAPM, which would only predict 9, 6%. The three-factor model explains the extra 4% that CAPM couldn't account for. This was a massive leap. The three-factor model turned what looked like alpha, stock-picking skill, into explainable risk premiums that anyone can harvest. The size premium has been more volatile. It was very strong from the 1920s through the 1970s, but has weakened in recent decades. Some argue small stocks are now more efficiently priced. The value premium has also been inconsistent. Growth stocks dominated in the 2010s tech boom, but over the full historical period, value still holds an edge. Carhart added momentum as a fourth factor. Stocks that have been going up tend to keep going up in the short term. The factor zoo keeps growing. Second, you can harvest these premiums yourself through factor ETFs. Tilt your portfolio towards small cap and value stocks deliberately, with lower fees than active management. The Fama-French model teaches us that returns aren't magic. They're compensation for bearing specific, measurable risks. Understanding the factors is understanding the market itself.